Hey, it's Eric from Self-Made Trading, and today you'll be learning how to day trade. Chapter 1, Intro to Day Trading. Today you will learn, what is day trading? How do I become a day trader? Picking a broker, PDT rules, order types, long trading versus short trading, and stock float. In this mini-series, there will be 3 chapters. Chapter 1, Intro to Day Trading. Chapter 2, Risk Management. And Chapter 3, How to Become Successful. So what is day trading exactly? Day trading is buying and selling shares of stocks within the same day. Day traders usually don't hold positions overnight. They look for all their opportunities to come intraday, whereas investors or swing traders look to hold their positions for a longer period of time. You have investors who are looking for holding their positions for a few weeks to a couple of years. And you have some swing traders who look for a day to a week or two to hold their position. Well, day traders, we're just looking for opportunities to come within the same day. One of the reasons people love day trading is because you can make quick profits. You don't have to wait days to see if a stock pans out or not. You can get in and get out and see immediate return on your money. Day trading can be extremely profitable and you can make a lot of money. But you have to have a proper trading plan, risk management, and a strategy to follow. Those things are critical. So, how do I become a day trader? Becoming a stock trader isn't hard. It's not rocket science, it's stocks. Things you need to become a day trader. You need a reliable computer, high-speed internet. You need to open a brokerage account. You need charts, and some charts are free. And you need to learn a proven market-tested strategy. Let's talk about opening a brokerage account. So this is an account that you just simply apply for. It's almost the same as opening a bank account. All you need to provide is information such as your name, your address, your telephone number. They'll ask you questions like, how long have you been day trading? Because if you've been day trading for, less than a year, they probably wouldn't want to give you margin. If you've been day trading for over a year, then they'll most likely give you margin at that point. So they'll ask you questions like that, and then they'll ask you for your identification, of course, to prove that you are who you say you are. So after you open up your account, all you need to do now is to fund it. Usually they give you 2 or 3 options to fund it. It just depends on the broker. Wire, Arch, and then sometimes credit cards are some of the deposit methods that they use that you can use to fund your account. Make sure you choose a broker that has fast executions. This is very, very important because you want to be able to get in and get out as fast as possible. You also want to look for a broker that has good commission rates. Understand that some brokers have higher commission rates, and over the course of taking trades throughout the day, you don't want that to eat into your profit. So make sure that you find a broker that has very low commission rates so you can keep as much of your profit as possible. And if you have any questions about different brokers or the one I used when I started off, simply just give me an email. That's what I'm here for. I don't mind helping you. So let's talk about PDT rules. PDT simply stands for pattern day trader. What this is a stock market trader who executes 4 or more trades in 5 business days in a margin account. Under the rules, a pattern day trader must maintain a minimum equity of $25,000 on any day that the customer day trades. So if you execute 4 or more day trades in 5 days, then you fall under the PDT rules. But don't let that stop you when you see the $25,000. Just understand that a lot of day traders don't have $25,000 to start off with in their account. So you can start where you are with what you have. There's plenty of brokers who will let you start with small accounts. Understand that I've built a small account before just to show that it can be done, so you can do it too. Don't let this be another reason of why you can't start your journey to becoming a successful stock trader. Stock float. The float of a stock is generally defined as the number of shares available to be traded in a given company. The stock float is different to the outstanding shares, in that the outstanding share count is the total number of shares the company has issued but are not necessarily available for trading. The float is the number of shares actually available for trading. So this is your supply. Why is this so important? Well, the size of a company's float has a direct impact on how the stock trades. The smaller a float, the more volatile the stock can become. If a stock has 1 million shares in its float and announces really good news, their share price will soar due to there being hardly any shares in the float. If there are hardly any shares in the float, this means that the shares are harder to buy and the price to buy shares will go up. Low float stocks can be very risky to hold because they can have violent moves in either direction. With so few shares available to trade, the impact on supply and demand can be significant. This is especially true if a company behind the stock is involved in a newsworthy event, because news can drive the price. They are susceptible to organize short and distort campaigns. In addition to this, low float stocks are usually micro caps or very small caps. This adds additional risk for anyone considering holding them for the long term. Stocks with larger floats tend to move a lot slower and give smaller moves for day traders to make quick profits. So larger floats are a lot different from small floats. So on the other hand, you have medium-sized floats. This is in the middle. So you have your small floats, you have your medium floats, and you have your large floats. Medium-sized floats are known to be the perfect combination of less risk and still being able to make the move intraday that most traders like to gain profits and see. The goal is to find a stock that will make great moves but have low relative risk, and this is why stocks with a float between 15 million and 60 million becomes the ideal candidates to trade and profit. Let's talk about order types. So you have limit orders, market orders, and stop orders. With limit orders, these orders require you to name the price of the most you're willing to pay to buy that stock, or the least you're willing to pay to sell it for. These are the orders that I usually use, limit orders. And then you have market orders. This order lets you get filled at market price. Day traders usually don't use these orders because it's like telling your broker that you will give them any price for this stock. I don't want any price because my entry is critical to my risk management. Let's talk about stop orders. Stop orders. This is a type of order that is triggered once the price crosses a certain price point. These orders are usually used to buy or sell at a loss once your order gets to a certain price point, or even if it crosses that point. So what that means is, whenever you're buying a stock, hopefully you need to make sure you have a trading plan. And inside of your trading plan, it should entail risk management. So if I'm buying a stock and I've done my analysis and I feel like this stock is going to go up, well, this is what's supposed to happen according to my risk analysis. Well, sometimes it doesn't always happen the way that you plan it. So therefore, you set yourself a stop order saying, just in case this stock doesn't go the way that I plan it to go, or it goes against my trading plan, I am only going to risk a certain amount of money. So I'm going to set a stop order to say, you know what? I'm only going to lose this amount of money if this stock does not go as planned. And so that's what a stop order does. It stops you from blowing your account. It stops you from losing more money than you plan on losing. And stop orders can be very useful. I love them, especially for new traders. So long versus short. The difference between long and short. The terms long and short refer to whether a trade was entered by buying first or selling first. A long trade is initiated by buying with the expectation to sell at a higher price in the future and realize a profit. A short trade is initiated by selling first before buying with the expectation to buy the stock back at a lower price and realize a profit. Long versus short. Long. When a day trader is in a long trade, they bought a stock or ticker and are hoping that the price will go up in order to sell it for a profit. Day traders will often use the terms buy and long. The term is often used to describe an open position, as in, I am long Apple, which indicates the trader currently owns shares of Apple. Traders will often say, I'm going long or go long to indicate their interest in buying a particular stock. Short. When a day trader is in a short trade, they sold a stock or ticker before buying it and are hoping that the price will go down. The seller will make profit on this stock once the price goes lower than the price they sold it for. Shorting is confusing for a lot of new traders, since in the real world we typically have to buy something in order to sell it. Well, in the financial markets, you can buy and then sell, or sell and then buy. Day traders will often use terms sell and short. The term short is often used to describe an open position, as in, I am short Snap, which indicates that the trader is currently short Snapchat. Traders will often say, I am going short or go short to indicate their interest in shorting a particular stock. So if you have any questions about being long or being short, or you want more information about it, email me. That's what I'm here for. I'm here to help you, and I don't mind helping. So don't just keep going. If you have any questions, and you need to make sure that you have the answers to it. You need to make sure you definitely educate yourself to know what long and what short is, because it's very, very important. So just email me if you have any questions. That's what I'm here for. So speaking of help, understand that just like anything, learning a new career can be frustrating, or understand that if you know nothing about stocks, or this is all confusing or new to you, know that I'm here to help you. That's the whole purpose of me making this video, is to help people. I want to help people. I want to show people how to make extra money part-time or full-time. Me, I trade about 2 hours out of the day, and then I have the rest of the day to do whatever I want to do with it. If that's what you're looking to do, great. If you want to do this full-time and trade all day, or that's fine also. But understand that if you need guidance, or maybe you're just afraid to take the first steps, or you need help to learn a strategy, you have questions that no one's answering, you've been through a million different YouTube videos, and you're still confused or don't know where to start, just don't be afraid to reach out to me and ask questions. Understand that I love helping traders and paying it forward. That's what it's about. Once you learn a skill, once you learn something, it's about giving back. And that's very, very important to me. And I feel like that's what all of us should do. This is a community. And so we should all be here to help each other grow and become the best traders that we can be. And so don't ever be afraid to reach out to me. That's the whole reason why I did this. Here's my contact info. My email address is eric@selfmadetrading.com, or you can reach me at www.selfmadetrading.com.